Hello, Tim Kerin here from Mortgage Choice in Kingsley. Today I just want to talk a little bit about the interest rate changes that have been going on over the last few years to try and help you quantify it, understand what's going on, and understand whether realistically there's anything that can be done to make things better for you and how to do it. So probably the first thing to talk about is just quantifying any rate change that's happened. So let's have a rule of thumb, for example. If you had a $100,000 loan and your rate went up by 1%, then that would be costing you $1,000 a year. Likewise, if you had a $400,000 loan and the rate went up by 0.25%, that would be costing you $1,000 a year. $1,000 a year is also roughly what it costs in fees and charges to change from one lender to another at the moment, unless you're breaking a fixed rate loan to do it, in which case you'll also have a fixed rate break cost on top of that. So 0.25% on a $400,000 loan is about 1 year's worth of interest in that situation is about what it costs to change lenders. So have a think about the rate change you've seen or the rate changes you've seen lately, and just quantify it in terms of multiply that rate change by the loan amount and figure out what it's costing you per year in loan interest to see how much of an effect it's actually having on your life. You might find it's more than you thought, you might find it's less than you thought, but I always find it's good to quantify these things because then you can decide how much of an issue it is and how much of your own personal resources to devote to resolving it. So that's the first thing. The second thing is, if you then do want to solve it, there's a few things I need to know to help you do that. One is what your lender's going to charge you to leave, and that's as simple as calling the lender up and saying, if I was to pay out my loan and close it today, how much would you charge me? The second thing you can ask them when you call them up and ask that question is, what's the best rate you're willing to give me to retain my business? While you're at it, find out whether they've classified your loan as owner-occupied or investment, and just check whether your loan is interest only or principal and interest. If you can figure out that is the cost of leaving, what rate they're willing to give to retain you, whether it's owner occupied or investment, and whether it's principal and interest or interest only. If you can figure out those four things and then get in touch with me, then I'm in a very good position to be able to quickly and effectively give you an idea of what we can do about it, based on which lender you're with and based on how we might be able to change things. It could be as simple as, if you switch from interest only to principal and interest, we might be able to save you 1/4 to 0.5%. It could be something as simple as that, or it could be as simple as telling your lender, I've moved into the house now it's owner-occupied purposes, please drop my rate. And they might be willing to do that, or they should be willing to do that if that's what's going on. So often it's a symptom purely of the way that the industry has changed in the last few years that's causing some of these rate rises. So I'll talk about that a little bit more first. Just briefly, a very top level summary of the last few years is that the government was very concerned about the amount of investment lending and about the amount of interest only lending that was going on across the country. And so they acted to stem the flow of that. And that's effectively caused banks to change rates depending on whether it's investment or owner occupied, and whether it's interest only or principal and interest, to the point where there's probably about a 1% gap in any given lender between the cheapest one, which is owner-occupied principal and interest, and the most expensive one, which is investment interest only. So it could be that just bringing the lender up to speed on which one you actually should be might be a problem solver. So that's the first thing that happened. The second thing that happened is the Royal Commission into Banking. You might have seen the headlines. That's causing lenders to get a much clearer idea of the exact compliance they need to do to be up to speed and to not get in trouble. And that's basically across the board causing lenders to increase how much they're spending on what we're going to call compliance, making sure they've dotted their I's and crossed their T's and asked all the right questions. And they're now monitoring brokers as well, a lot more than they used to as well. So for me, it hasn't really changed how I do things. I've been doing the right thing by people for a long time, and that's been the core of how I run my business. And I think across the broking industry, that's how we've been regulated for a long time. So that hasn't really changed, but what has changed is the procedures that lenders operate under to make sure that that's what's going on and make sure that they're doing the right thing as well. And that's causing them to need to spend more money per loan they do. And that's a cost that they've recently been passing on to the customer as well. The final thing, the icing on the cake, is according to lenders, and I'm not in the background at banks monitoring this, but according to lenders, their cost of funds has been going up lately as well. That is, their margins are being squeezed. And they've been absorbing that cost for a while, and now they're starting to pass that on. As of August was the first time we saw a lender do that. So there's been a few different reasons over the last few years, which are fairly, in some cases, unique in the history of Australia, and in some cases fairly uncommon, that have caused rates to change a lot and caused a lot of confusion. And that might mean that your rate legitimately is a long way from where it should be right now, and it could be a fairly easy fix, or it could be impossible to fix. But that's something we can talk about. So I think it's not necessarily the case that this is the start of a long-term trend of rates going up. It might be, but just because the Reserve Bank hasn't put rates up, it's been the case for probably something like a decade now that lenders have been changing their rates irrespective of what the Reserve Bank's doing, because there really isn't too much of a connection there. It's not like the lenders actually get their money off the Reserve Bank to any great extent, like perhaps they used to decades ago. So it's not surprising that rates are changing whenever lenders need to change their rates to make sure that their margins are healthy. And it's not surprising that there's a lot of that going on at the moment, because there's been a huge amount of confusion and chaos in the lending industry that's culminated in this Royal Commission into banking. So that's what's going on in the background, and that may mean that the interest rate you're on now is simply where it needs to be, and that maybe we can't get you a better deal elsewhere. But it could also mean that the wrong purpose is in there, or something as simple as switching to principal and interest might solve your problem. So if you can find out from your bank, again, just to reiterate, what it's going to cost you to leave, what they're willing to do to retain you, whether it's interest only or principal and interest, and whether it's investment or owner occupied, and bring that information to me, then I'm in a very good position to help you quickly figure out the solution and whether we can do anything to get you a better deal. I hope that helps.